Welcome back to Talk Tickers. It is Wednesday, January 24, 2026. We are deep in the heart of earnings season.
The coffee is definitely flowing.
It really is. We're doing what we do best, taking the noise of an earnings call and turning it into a signal. Today, we're zooming in on a regional bank out of the Southeast, SmartFinancial, Inc., tickers SMBK.
Yeah. And, usually when you say a regional bank, people sort of tense up, right? Especially after the last few years. You're expecting bad news on commercial real estate or deposit flight. But digging into these filings, this is a very different story.
It really is. And the market seems to get it. We're recording just after the close, and the stock popped pretty nicely.
How much was it up?
Trading up between, 3.4 and 3.6%?
Yeah.
Right around the $40 in the search.
Exactly. And that price action tells you a lot. The sentiment is constructive, even bullish. But, and this is the key, it's not because of some flashy announcement.
No.
The market liked this report because it was boring. And in banking right now, boring is beautiful.
I love that phrase. Boring is beautiful. So let's unpack this boring but beautiful quarter. What did they deliver? Let's start with the headlines.
Sure. So top and bottom line, they beat. GAAP earnings per share came in at $0.81.
And consensus was what, 78?
That's 78, yeah. So a solid 3-cent beat.
Okay, and a nice surprise. And what about revenue?
Better or not nice. Revenue was $53.31 million. The street was looking for something closer to $51.39 million.
Wow, so that's a pretty significant beat on the top line.
It is. And net income, $13.7 million for the quarter, just for context. That's up from $9.6 million in the fourth quarter of 24. So really strong growth.
Okay, so headlines are good, but you know how it is. Sometimes the beat is messy. You look under the hood and it's all one-time items. Was this a clean quarter?
Incredibly clean. And there's one metric that just proves it. This was their 7th consecutive quarter of positive operating leverage.
7 quarters in a row. Let's just pause there. Operating leverage gets thrown around a lot. For anyone listening, why is that the golden metric for a bank?
It's all about efficiency. It just means your revenue is growing faster than your expenses are.
Simple as that.
Yep. And to do that for 7 straight quarters in this rate environment, it proves you're not just buying growth, you're actually scaling the business efficiently. It's really hard to do.
And that efficiency should translate into shareholder value.
Right. Ideally, yes. And it does here. Look at the tangible book value per share. It's now $26.85.
Which is up. How much for the year?
It's up 13% annualized for the quarter. And get this, 17% for the full year.
17%. That number really jumped out at me. Growing the liquidation value of the bank by 17% in a single year feels aggressive.
It is, but in the best possible way. It means the company is a compounding machine. If you can do that without taking on a ton of obvious risk, you're winning. That's why the stock popped. It's a validation.
Okay, so let's get into the nuts and bolts of how they did it. I want to talk margins. We've been hearing about in-M net interest margin compression for what feels like an eternity.
For sure.
But SMBK actually expanded their margin.
They did. This is where the story gets really interesting. Their net interest margin expanded to 3.38%. That's up 13 basis points from last quarter.
Up 13 bips. That's not a rounding error. How are they pulling that off when everyone else is getting squeezed?
Well, it wasn't just about charging more on loans. A huge piece of it was liability management, basically controlling what they pay for their money. Their deposit costs actually fell.
They fell in this environment. By how much?
Dropped to 2.26%. That's down 18 basis points. And a huge part of that was them strategically getting rid of their hot money.
The brokered deposits. I saw that in the notes. Break that down for us. What's the difference?
So a core deposit is, your local business's checking account. It's sticky, it's loyal, and it's cheap.
Right.
A brokered deposit is what I call mercenary money. It's cash from a broker just chasing the highest rate in the country. It has zero loyalty.
So it's expensive, and it's the first to leave if you lower the rate.
Exactly. It's a margin killer. And SMBK paid off $112 million of these deposits in the quarter.
And what were those costing them?
About 4.27%.
Ouch. Yeah, that's a heavy cost of funds.
It is. So they let that expensive money walk out the door, and they plan to pay down another $44 million in Q1. They're winning the beta game. Their funding costs are dropping faster than their loan yields.
Okay, but that brings up a question about the balance sheet. If you're pushing $112 million in deposits out the door, shouldn't your overall deposit base shrink?
Logically, yes. But that's the aha moment in this report. It didn't.
It grew.
Even after getting rid of all that brokered money, their total deposits still grew by $102 million. That's an 8% annualized growth rate.
So that has to be core deposit growth then. Real customers walking in the door.
Precisely. They're upgrading the quality of their funding base, trading bad calories for good calories. And on the other side of the balance sheet, loans grew by $141 million.
Which is what, annualized?
A 13% annualized growth rate,
Yeah.
all organic.
13% loan growth. Okay. The skeptic in me has to ask, is that safe? Are they just lending to anyone to juice the numbers?
It's the right question to ask. But the credit quality metrics say no. Non-performing assets are just 0.22%.
That's tiny.
It's nothing. Now, I did see, you have to read the footnotes, there was a specific provision, something about fountain equipment.
Yes, good catch. There's a provision expense of about $4.1 million, and they called out a subsidiary that deals with, I guess, soda fountain loans.
Yeah, specialized beverage equipment. It's a weird little niche. It looks like they had some trouble in that one specific portfolio and decided to reserve for it aggressively.
So it's contained.
It seems to be. Because if you look at the whole bank, net charge-offs for the entire year were only 8 basis points.
Less than 0.1%.
Right. So the growth isn't coming at the expense of quality.
Which brings us back to the boring theme. CEO Billy Carroll actually said it on the call, didn't he? He said, we're kind of a boring story.
He did. And it's so refreshing here. He was talking specifically about M&A.
Right. The old regional bank playbook. Grow by acquisition. Buy the bank down the street.
Correct. But Carroll was clear. They are not looking for deals unless it's something unique and special. They would much rather grow organically.
Why is that a better strategy right now?
Because buying banks is messy. You've got integration risk, culture clashes, and you usually overpay. If you can grow your own loan book at 12 or 13% just by hiring good people, your return on equity is going to be so much higher. It's just cleaner.
Speaking of hiring good people, let's talk about Columbus, Georgia. This was an expansion they highlighted. They're not buying a bank there, are they?
No, this is a classic lift-out strategy.
Right.
And it's brilliant. They saw market disruption in Columbus, probably another bank merger causing chaos.
And they just went in and poached the talent.
They poached the talent. Instead of buying the building and all the legacy problems, they just hire the best bankers who already have the local relationships. They open a cheap loan production office.
So the customers follow the banker, not the brand.
That's the idea. Once the banker brings her book of business over, then you can build out a full branch. It's such a low-risk, high-return way to expand.
That is smart. Now, looking ahead, they did throw out a pretty ambitious number, an internal goal of hitting a $1 EPS run rate by the end of 2026.
Yeah, which would imply a $4 annualized earnings power.
So we just printed $1.81. Getting to $1 in, what, a year's time? Is that realistic or just cheerleading?
It sounds ambitious, but when you look at the moving parts, it's actually doable. It doesn't require a miracle. It just requires continued execution.
So what's the bridge to get there? The CFO, Ron Ginsky, gave some guidance.
Yeah, the NINA outlook is the key. He's projecting Q1 NIM between 3.40% and 3.45%. Remember, we just finished at 3.38%.
So immediate continued expansion. And he even floated hitting 3.5% by year-end 26.
He did, and that's all driven by their funding costs. They expect another 17 to 18 basis point drop in funding costs just in Q1.
As the Fed cuts flow through.
Exactly, and this is key for listeners. About 45% of their deposit base is variable rate. So when the Fed cuts, their costs drop almost instantly, but their new loans are still being put on at higher rates. It's a great position to be in.
Okay, what about expenses, though? Can they control spending while they're growing like this?
That's the discipline part. They're guiding for operating expenses to stay in the $33.5 to $34 million range for Q1, aiming for about 5% growth year over year.
So if revenue is growing way faster than 5%.
That's the magic formula. That is positive operating leverage in action. And that's how you get from 81 cents to $1 of EPS.
Okay, zooming out before our last segment, what does this quarter from SMBK tell us about the regional banking sector as a whole?
I think it's a signal that the best operators can thrive. It proves that you can still expand margins even as rates fall, as long as you have the right funding mix. SMBK is showing everyone the model that works.
A market of haves and have-nots, and they're firmly in the have column.
No question.
All right, let's shift gears. It's time for our This Is Not Financial Advice segment.
The disclaimer is in the title, everybody. We are just brainstorming here. Do your own homework.
Definitely. But let's imagine we're in that hedge fund meeting. The coffee is stale, and you've got to pitch a trade based on this call. What's the pitch?
Okay. I call this one the boring banker leverage play.
I'm in. What's the thesis?
The thesis is that the market still lumps all regional banks together. It prices them like they all need to merge to survive. SMBK is proving they can compound tangible book value at 17% all by themselves.
So you just buy the stock.
Let's make it a pair trade.
Yeah.
You go long SMBK and you short a basket of what I'll call serial acquirer regional banks, the ones who can only grow by doing messy deals.
I like it. A bet on the efficiency of boredom.
You got it. And here's the logic. If they hit that $1 EPS target, that's $4 annualized. At a $40 stock price, that's 10 times forward earnings. That's way too cheap for a business compounding this fast and this cleanly.
So it's undervalued on its own merits. Is there an outrageous kicker?
Oh, there's always a kicker. The kicker is if they prove this Columbus lift-out model works, they actually become the #1 takeover target in the region.
Wait, but I thought the whole point was that they don't need to sell.
That's exactly why they'll get a bid. The best acquisition targets are the ones that don't need a partner. Some big, slow-growing, super regional bank will look at this clean, organic growth engine and say, I have to have that.
The scarcity premium. You're buying their competence.
Right. A high-quality franchise like this could easily command a 2x book value multiple in a buyout. With book value growing, that could put the stock closer to $54, maybe $56.
That is a serious upside from $40. So you win if they execute and you win bigger if they get bought.
That's the idea. But the catch is execution. They have to keep being boring and perfect. No more fountain equipment blowups. But based on this quarter, the odds look pretty good.
I like the trade. Betting on competence. It's a bold move.
Let's see if it pays off.
All right, let's wrap it up. So to recap, a beat and raise quarter from SmartFinancial without the usual drama.
EPS, $0.81, a beat. Revenue, $53.31 million, also a beat.
Margin expansion is the real deal, hitting 3.38%, and the strategy is crystal clear. Organic growth over risky M&A.
And that 3.5% pop in the stock tells you everything. In this market, certainty and clean execution are commanding a huge premium.
Absolutely. Well, that does it for this deep dive, a really fascinating look at how a bank can win by just focusing on the fundamentals.
Sometimes the best investment is the one you don't have to lose sleep over.
Couldn't have said it better. As always, thank you for tuning in to Talk Tickers. Do your own due diligence, and we'll catch you on the next one.
Stay curious, everyone.